Accenture just beat earnings expectations, so why is the stock sinking? One of the world's top consulting giants is undergoing a quiet storm, shrinking contracts, federal pullbacks, and big AI bets. Is this a rare buying opportunity or a red flag? Stay tuned to find out what's really going on with Accenture. Founded in 1951, Accenture delivers a wide range of professional services that include strategy, consulting, and technology solutions. The firm helps most of the world's largest companies improve their operations and IT infrastructure by providing systems integration and application management, data management, security, software engineering, AI, and automation services. Accenture works across dozens of industries, including consumer goods, retail, life sciences, banking, insurance, communications, healthcare, chemicals, and utilities. The company currently offers a starting dividend yield of 2.23%. while the 5-year average is only 1.46%. The price-to-earnings ratio is currently 19.1, compared to a 5-year average of 27.3, while the sector average is currently 23.8. The expected price is currently estimated to be between $328 and $401, whereas the company can now be purchased for around $255, making it appear significantly undervalued. Accenture currently pays an annual dividend of $5.92, distributed quarterly. The next payout will be on August 15th, and anyone who owned the stock by July 10th will be eligible. The following payout is likely to be an increased amount, which means the yield on cost could rise shortly after the purchase. The most recent dividend increase was on September 24th last year, when the dividend was raised by 14.7%. The 5-year average increase is 12.9%, while the 10-year average is 10.6%. It is clear that dividend growth has been accelerating over the past 10 years, though this does not guarantee the trend will continue in the future. The earnings payout ratio over the past 12 months was 47%. For similar companies, a payout below 60% is expected, and Accenture has consistently maintained this level over the past 10 years. The same applies to the free cash flow payout ratio. Both earnings per share and free cash flow per share have been steadily growing year over year. The earnings per share growth and sales growth charts have remained positive over the past 10 years, although growth has noticeably slowed in recent years. We'll discuss the reasons behind this in the second half of the video, so stay tuned if you're interested in the cause. The company consistently repurchases its own shares, and total sales have been increasing steadily. These are key factors for long-term investors. While the return on equity and return on invested capital charts have shown a declining trend for some time, both metrics still remain well above minimum expectations. Operating and free cash flow margins have also consistently stayed above the minimum expected levels over the past 10 years. The company currently holds more cash than debt, which is why there's effectively nothing visible on the net debt to EBITDA and net debt to capital charts. Naturally, the interest coverage is also in excellent shape. The company is currently available with a record high starting dividend yield of 2.32%, even though the next dividend increase is still upcoming. This is likely to be a significant raise again, considering the last increase was 14.7%. The credit rating is AA-, which is considered very strong, and the dividend appears to be very safe. Based on these factors, the company seems significantly undervalued. You might be asking, if this company is so great, why hasn't anyone noticed? In the second half of the video, we'll also talk about the challenges the company will have to face in the near future. So definitely stick around if you want to understand the full picture. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Alright, let's break down Accenture's latest earnings report for Q3 fiscal 2025. On paper, the results are strong, but the stock still took a hit. So what's going on under the surface? Let's take a look. Let's begin with revenue, because that's usually the first headline number investors look for. Accenture brought in $17,730 million in revenue this quarter. That's up 8% compared to the same quarter last year in US dollars and 7% in local currency. Notably, this beat their guidance range, especially after adjusting for foreign exchange. This tells us that, despite global uncertainty, client demand for Accenture's services remains strong across the board. Now let's break that revenue down by the types of work Accenture delivers. Consulting revenue came in at $9,100 million, up 7%, and managed services hit $8,720 million, up 9%. This balance between project-based work and ongoing support is healthy. It shows companies are investing in transformation, but still looking for long-term operational help too. Let's take a quick look at how this breaks down geographically. In the Americas, revenue rose 8% in dollars and 9% in local currency, leading all regions. EMEA followed with 8% growth, and Asia-Pacific grew more modestly at 5%. This shows that North America continues to be a stronghold, while Asia-Pacific likely reflects some conservative enterprise budgeting and macro pressure. Okay, so where is this revenue coming from in terms of industries? The biggest standout this quarter was financial services, which posted 13% growth. That's a clear sign that banks, insurance companies, and fintechs are investing in compliance, digital infrastructure, and AI-driven transformation. Other industries like health and public service, products, and resources posted solid, steady growth between 5% and 7%, a strong base for Accenture. But now, let's talk about something that raised some eyebrows. New bookings. This quarter, new bookings totaled $19,700 million. That's actually a 6% decline compared to Q3 last year and 7% lower in local currency. Why is that a big deal? Because bookings are a forward-looking metric. They tell us how much future work is in the pipeline. And this is the second quarter in a row where bookings have dropped. That's likely a key reason investors have been a bit cautious. Looking deeper, consulting bookings were $9,080 million, and managed services made up the rest at $10,620 million. Now let's talk about something that's not declining, AI. Accenture booked $1,500 million in generative AI work this quarter alone. That's a huge deal. It signals that clients aren't just talking about AI, they're actually putting serious money behind it. This is a long-term growth driver for Accenture and a key reason some analysts remain bullish despite near-term booking softness. Let's shift gears now and talk about profitability. Accenture's operating margin came in at 16.8%, up from 16.0% last year. That's an 80 basis point improvement. Their net income rose to $2,240 million, and diluted earnings per share EPS increased 15% to $3.49. Even when adjusted for prior year optimization costs, EPS was up 12%. So while revenue grew 8%, profits grew even faster, meaning Accenture is becoming more efficient while expanding. Now let's take a look at cash flow, dividends, and share buybacks. Three big signals of financial health. Free cash flow this quarter was $3,500 million, up from $3,020 million a year ago. That's a great number. It gives Accenture the flexibility to return value to shareholders and reinvest in growth. And they did just that. Accenture raised its quarterly dividend by 15%, now paying $1.48 per share. They also repurchased 6 million shares this quarter, spending $1,800 million, including nearly all of that in open market buys. These moves suggest the company sees its own stock as undervalued and wants to reward long-term investors. All right, let's talk a little bit about the company's outlook moving forward. For the full fiscal year 2025, Accenture now expects revenue growth of 6 to 7% in local currency, an operating margin of 15.6%, and EPS between $12.77 and $12.89. They also raised their free cash flow guidance to $9 billion to $9,700 million, showing confidence in both profitability and cash generation for the remainder of the year. Overall, this is a cautiously optimistic forecast. It acknowledges some near-term booking pressure, but still reflects long-term strength. So to wrap things up, let's summarize the key takeaways from this quarter. Recap. What's actually going on here? So stepping back from the numbers, what's actually working for Accenture right now? Well, both revenue and profit came in above expectations, which tells us the business fundamentals are solid. Earnings per share jumped 15%, and margins improved, meaning they're not just growing, they're growing more efficiently. They're generating strong cash flow, which allowed them to boost their dividend by 15% and continue buying back stock aggressively. Clear signs of confidence from leadership. And let's not forget the $1.5 billion in generative AI bookings. That's not a side story anymore. It's becoming a real growth engine. Even better, despite market concerns, Accenture kept its full-year guidance intact and even nudged parts of it slightly upward. But what should investors be watching closely? Well, the biggest concern is that new bookings fell for the second quarter in a row. That's the pipeline, the work that turns into future revenue. A slowdown there can't be ignored. Growth in Asia-Pacific is also losing momentum, and some investors are starting to wonder whether short-term demand, especially for consulting, is starting to soften. It's not panic time, but it is a signal to watch closely in the quarters ahead. So the big question is, are investors overreacting to a short-term bookings drop, or are we seeing the early signs of broader demand weakness? With strong financials and long-term AI positioning, Accenture could be quietly building momentum if it can navigate short-term uncertainty. But now I want to hear from you. What's your take on Accenture? Had you heard of the company before this video? Are you already tracking it? Or maybe even holding shares in your portfolio? Do you think it's a long-term winner, or are you staying on the sidelines? Drop a comment down below and let's talk about it. I read every one of them. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.